Think about your own finances for a sec. That rent payment coming up, maybe a credit card bill, tuition. Those are immediate things you owe, right? Promises you've made.
Yeah, things you know you'll have to pay out soon.
Exactly. And companies. It's really no different. They have obligations too, and getting a handle on the short-term ones, these current liabilities, is just crucial for understanding how financially nimble they are.
Absolutely fundamental. It tells you about their immediate health.
So today we're doing a deep dive into current liabilities and contingencies. We're drawing heavily from the classic intermediate accounting by Kiso, Wigant, and Warfield.
A great resource. We'll try and boil down the key stuff.
Our goal here is really to slice through the jargon and give you a clear picture of these concepts. We want to focus on how they actually play out in financial reports and, the big decisions businesses make.
Think of it as your shortcut to understanding a really core piece of corporate finance. We want you to be able to spot these things in a company's financials.
Okay, so let's unpack this then. What exactly is a current liability?
At its heart, it's an obligation the company expects to settle pretty soon, usually within a year, or maybe their normal operating cycle if that happens to be longer.
And settling it means
What?
using up cash.
Typically, yeah. Using existing current assets like cash, or sometimes even creating another short-term liability to pay off the first one.
Got it. But before we even worry about current versus long-term, what makes something a liability in the first place? There are rules for that, right?
Oh, definitely. 3 key conditions. First, there's got to be a probable future sacrifice. The company is likely going to give up cash or goods or services down the line.
Probable. Okay, what else?
Second, it has to be a present obligation. It's unavoidable now, not just something that might happen.
Ah, okay. Not just a maybe.
And third, critically, this present obligation must stem from a past transaction or event. Something already happened to create this debt.
So if any one of those isn't met, it's not a liability yet.
Exactly.
Yeah.
Think about Astra Inc. mentioning anticipated losses from pending transactions. Anticipated means no past event, no present obligation, so no liability recorded.
Or that Henlo Co. example with a possible lawsuit. If it's just possible, not probable.
Then you don't record it. It fails that first test probability. It all hinges on those 3 conditions: probable future sacrifice, present obligation, past event.
And the current part is just about the timing. Within a year or the operating cycle?
That's the basic split, current versus long-term. It's a key piece of information for assessing liquidity.
Right, liquidity. Let's talk about that. Why is the short-term stuff so important? Why the focus?
Well, think about investors or banks lending money. They care deeply about whether a company can pay its immediate bills. Can it meet payroll next week? Can it pay suppliers on time?
that seems pretty fundamental.
It is. It's about short-term survival and flexibility. That's why we have ratios like the current ratio.
Which is current assets divided by current liabilities.
Spot on. It gives you a quick look at how many dollars of short-term assets a company has for every dollar of short-term debt. A basic coverage measure.
So like that Target example from a few years back, their ratio was 0.89. That sounds low. Less than $1 of assets for each dollar of debt.
On the surface, yeah. A ratio below 1 often suggests that current liabilities are greater than current assets, which could signal potential liquidity issues. Generally, higher liquidity means lower risk.
But you mentioned it's not always the whole story.
Right. As we'll get into, some very successful companies operate with low current ratios by managing their working capital really aggressively. So context matters.
Okay. And how are these liabilities generally accounted for? Is it complex?
For most current liabilities, it's fairly straightforward. Because they're due so soon, they're usually just recorded and reported at their full maturity value. The time value of money isn't usually significant enough to bother calculating present value.
Makes sense. Where does the complexity come in then?
It often arises when the timing or amount isn't crystal clear, like unearned revenues, money received up front. That's a liability until you deliver the service. Or contingencies, those maybe liabilities we talked about, they only get recorded if they become probable and you can reasonably estimate the amount.
Okay, let's dig into some common types then. Accounts payable seems like the most basic one. Money owed to suppliers.
Pretty much. Balances owed for goods, supplies, services bought on credit, usually due in 30, maybe 60 days. The key accounting is just making sure you record it when you receive the goods or when control transfers, and making sure your inventory records match up with what you owe.
Can accounts payable tell you anything else? You mentioned working capital.
Yeah, definitely. If you see a company, especially a big retailer, with consistently huge accounts payable relative to its sales, it might mean they're really stretching out payments to suppliers.
Kind of like using suppliers as a source of financing.
Exactly. It can be a smart way to free up cash, basically getting an interest-free loan. But, it can put pressure on the suppliers, and it makes comparing that company to others a bit trickier if they don't do the same thing.
Interesting. Okay, moving on from accounts payable, notes payable. How are they different?
Notes payable are more formal. They're written promises to pay a specific sum on a specific date. They can be short-term or long-term.
And they can have interest.
Right. You have interest-bearing notes. Pretty straightforward. Say, Eat Street borrows $100,000 at 6% for 4 months. They record the $100 K liability, and then each month they accrue interest expense and increase interest payable. Then they pay back the $100 K plus the total interest at the end.
Simple enough. But then there are zero interest notes. How does that work? Sounds too good to be true.
Aha! It is. There's no free lunch. With a zero interest note, the interest isn't explicitly stated, but it's built in. The borrower actually receives less cash up front than the face value of the note they promised to pay back.
So the difference is the interest.
Precisely. Let's say Eat Street issues a $102,000 4-month zero-interest note, but only gets $100,000 in cash. That $2,000 difference is the total interest cost. It's initially recorded in a contra liability account called discount on notes payable.
A contra liability, so it reduces the note's carrying value.
Exactly. The carrying value starts at $100,000 the cash received and increases over the 4 months as that discount is amortized to interest expense. By maturity, the carrying value reaches the full $102,000 face amount that needs to be repaid. It just recognizes the interest cost over the life of the note.
That makes sense. It reflects the true cost of borrowing. This whole area of is it a liability or not can get fuzzy sometimes, can't it? Like those PPP loans during the pandemic.
Oh, absolutely. That was a prime example.
Well,
Because of the forgiveness clauses, companies weren't sure, is this debt that might be forgiven or is it more like a government grant closer to revenue?
so what happened?
There was diversity in practice. Some treated it as debt, others as income. The accounting standard setters basically had to step in and emphasize the need for really clear disclosures in the notes so anyone reading the financials could understand how the company was treating those funds. It really highlighted how new situations can challenge existing rules.
Okay, shifting gears a bit. Sales tax payable. When I buy something at a store, that sales tax isn't really the store's money, is it?
Not at all. The retailer is just acting as a collection agent for the government.
Hmm.
The tax is an expense for you, the customer. For the retailer, the sales tax collected is a current liability until they hand it over to the tax authority.
So if their sales register shows $150,000, but that includes a 4% sales tax.
They need to back out the tax amount. They'd figure out the actual sales revenue, $150,000 and $1.04, and the difference is the sales tax payable liability they need to remit.
Got it. And what about income taxes payable? This is for corporations, right?
Mainly, yes. Corporations are separate legal entities, so they pay income tax on their earnings. They calculate their taxable income, figure out the tax based on the rate, and record an income tax expense and a corresponding income taxes payable liability.
What about like sole proprietorships or partnerships?
They typically don't show income tax liabilities on the business's books because the income flows through to the owners, who pay the tax personally. Also, a key point is that the income calculated for accounting purposes often differs from the income calculated for tax purposes, which leads to things like deferred tax assets and liabilities, a whole other complex area.
Right. Okay, another big one, employee-related payables. This must be a huge chunk for most companies.
Definitely. It's not just salaries and wages. You've got all the deductions withheld from employees' paychecks.
Like income tax, Social Security, maybe health insurance premiums, union dues.
Exactly. The employer holds on to that money temporarily. It's a current liability for them until they pass it along to the government, the insurance company, the union, whoever. They're acting as a collection agent again.
And then there are taxes the employer pays.
Yes, employer payroll taxes. Things like the employer's matching share of Social Security and Medicare, FICA, and federal and state unemployment taxes, UTU and SUTA. These are an expense for the company and create another liability until paid.
So putting it all together in a payroll journal entry must involve quite a few accounts.
It does. You debit salaries and wages expense for the gross pay. Then you credit cash for the net pay going to employees, and you credit various payable accounts for other withholdings, income tax payable, FICA payable, union dues payable, etc. Then you have a separate entry to record the employer's payroll tax expense, debiting payroll tax expense, and crediting the related payables. FICA payable again, UT payable, SUTA payable.
Wow, okay. Lots of moving parts. What about things like paid vacation time, compensated absences?
That's another important one. Companies need to account for the cost of paid time off that employees earn but haven't used yet, like vacation or sometimes sick leave.
When do they have to record a liability for that? Is it when the employee actually takes the vacation?
No, it's generally accrued before that, when the employee earns the time off. There are four conditions, similar to the liability definition. The obligation arises from services already rendered by the employee. The rights either vest or accumulate.
Vest means they get paid for it even if they leave, and accumulate means they can carry it over.
Correct. Third, payment must be probable. And fourth, the amount needs to be reasonably estimable. If all four are met, the company should accrue the cost.
So if Pupjoy estimates its employees have earned, say, $50,000 worth of vested vacation time by year end,
They'd record salaries and wages expense of $50,000 and a salaries and wages payable, or compensated absences payable, liability of $50,000 in that year, even if the vacations are taken next year. It matches the expense to the period the benefit was earned.
what if the pay rate changes between when it's earned and when it's taken?
Good question. You generally accrue the liability based on the pay rates in effect when the time is earned. When it's paid out later at a potentially higher rate, the difference is typically just handled as an adjustment in the period of payment.
And sick pay, is that accrued too?
It depends. If sick pay vests, it's accrued like vacation.
Mm.
But if it only accumulates and payment depends on an actual future illness, companies often don't have to accrue it because it might not be probable they'll actually pay it out. Practices vary there.
One more in this category, bonus agreements.
Right, like year-end bonuses based on company profits. Think of Ford paying out profit sharing. Accounting treats these as additional wages.
So expense in the year earned.
Exactly. If Palmer Inc. calculates a $10,700 bonus pool for employees based on 2025 profits, they'd record salaries and wages expense and a bonus payable liability at the end of 2025, even if they actually pay it out in January 2026.
Okay, that covers a lot of the payable side. What about when cash comes in before the company actually does anything, like buying a season ticket way before the games start?
Ah, yes, unearned revenue, or sometimes called deferred revenue. It's a really common current liability.
So the company gets cash, but they haven't earned it yet.
Precisely. They debit cash, but instead of crediting revenue, they credit a liability account, like unearned ticket revenue or unearned subscription revenue,
And the revenue gets recognized when?
when they satisfy the performance obligation. So for those season tickets Allstate University sold, they'd initially record all the cash received as unearned ticket revenue. Then, as each game is played, they transfer a portion of that liability over to ticket revenue.
Makes sense. Airlines must have massive amounts of this.
Huge amount. And think about gift cards, too. That's another classic example.
Right. You mentioned Starbucks and Amazon having billions in gift card liabilities. When I buy a gift card, it's not revenue for them yet.
Nope, it's a liability. They owe you goods or services. Revenue is only recognized when you redeem the card.
What about cards that never get used? That breakage.
Good point. Companies now estimate the amount of gift card value they expect won't be redeemed due to the breakage. They typically recognize this breakage revenue proportionally as the other cards are redeemed. It's based on patterns of redemption.
So if Haven Retailers sells $1,000 in gift cards and $600 are redeemed, and they estimate 20% breakage overall.
They'd recognize the $600 redemption revenue plus a portion of the estimated $200 breakage revenue based on how much of the non-breakage value has been redeemed. It gets a bit technical, but the idea is to recognize breakage revenues systematically.
Okay. And customer advances or refundable deposits? Similar idea.
Very similar. If Ethan Allen gets a big down payment from Central Perk for custom couches, that $300,000 is a liability unearned revenue or customer deposits until they deliver the couches.
And refundable deposits, like a security deposit for an apartment.
Same logic. The landlord collects the cash, but it's a liability, deposits payable or similar, because they expect to return it, assuming no damages. It only becomes income for the landlord if the tenant forfeits it according to the lease terms.
Yeah. If we connect this to the bigger picture, we need to tackle contingencies. These sound like the really uncertain items and the maybe liabilities.
That's a good way to think about them. A contingency is basically an existing situation where there's uncertainty about a possible gain or, more often, a loss. And that uncertainty will only be resolved by some future event happening or not happening.
We're mostly focused on loss contingencies here, right? Things that could cost the company money.
Primarily, yes. These can lead to what we call a contingent liability. a potential future obligation dependent on that uncertain future event.
And the accounting rules from FASB have categories for how likely the loss is. Probable, possible, remote.
Exactly. Probable means it's likely to occur. Reasonably possible is more than remote, but less than likely. And remote is just a slight chance. This likelihood is crucial for deciding what to do.
So how does that dictate the accounting?
Here's the key. To actually record a loss contingency, meaning book an expense and a liability, two conditions have to be met. First, it must be probable that a liability has already been incurred as of the balance sheet date. And second, the amount of the loss must be reasonably estimable. Both have to be true.
Both probable and estimable. Okay. So if it's only reasonably possible.
Then you don't record it, but you generally have to disclose it in the footnotes to the financial statements. Give users a heads up.
And if it's remote?
Usually, nothing. No recording, no disclosure.
Can you give an example of accruing one?
Sure. Take that good person company guaranteeing a loan for the Boys and Girls Club. If, later, it becomes probable the club will default, and good person can reasonably estimate they'll have to pay out, say, $1.8 million. Then they record a $1.8 million loss and a guarantee liability. The uncertainty has reached the threshold for recording.
What about something like a lawsuit? If Kroger gets sued?
They'd assess the situation. If their lawyers say it's probable they'll lose, and they can estimate the damages, they accrue it. But if the lawyers say payment is not probable, then even if they could estimate an amount, they wouldn't record a liability. Maybe just disclose it if it's reasonably possible.
Makes sense. Warranties are another big one, right?
Absolutely. Very common contingency. There are two main types. First is the assurance type warranty.
That's the basic one included with the product. Like, it'll work as expected for a year.
Exactly. It's part of the sales price, a guarantee of quality. For these, the company estimates the future costs of honoring those warranties, repairs, replacements, and records that estimated cost as an expense in the period the product is sold.
So they record a warranty expense and a warranty liability up front.
Right. Even though the actual repairs happen later, it's matching the expense with the revenue from the sale. Candy Machinery selling vending machines would estimate the average warranty cost per machine and accrue that total liability when the machines are sold.
Okay, but then there's the other kind, service-type warranties, like extended warranties.
Yes, these are sold separately from the product. They provide an extra service beyond the basic quality guarantee.
So they're accounted for differently?
Totally different. Because it's sold separately, it's treated as a separate performance obligation. The cash received for the service-type warranty isn't revenue up front.
It's unearned revenue.
You got it. It's recorded as unearned warranty revenue, a liability. Then that revenue is recognized over the life of the warranty contract, usually on a straight-line basis. So Hamlin Auto selling a car and a separate $900 three-year warranty would book that $900 as unearned revenue initially and then recognize $300 of warranty revenue each year for 3 years.
Okay, that distinction is important. What about things like coupons or premiums, like buy 10 boxes, get a free bowl?
Consideration payable. These are used to stimulate sales. If the premium or coupon offers a material right to the customer, it creates a performance obligation and, potentially, a liability for the company.
How do they account for that?
They have to estimate how many customers will actually redeem the offer. Based on that estimate, they record an expense and a liability for the cost of the premiums they expect to provide. Fluffy Cake Mix, offering that mixing bowl, would estimate redemption rates and accrue a premium liability for the cost of the bowls they expect to send out.
So far, all losses. What about gain contingencies? What if a company thinks it might receive money?
The accounting is very different here due to conservatism. Gain contingencies, like potential winnings from a lawsuit or an insurance claim that's not yet settled, are not recorded in the financial statements.
Not at all, even if it seems likely.
Nope. You don't record gains until they are realized or realizable. So, high-tech winning a lawsuit but not knowing their share yet, no gain recorded. You might disclose a gain contingency in the notes, but only if the probability of receiving the gain is high. Conservatism says recognize losses when probable, but wait on gains.
Got it. Okay, let's shift to how all this looks on the actual financial statements, presentation, and analysis. Where do we usually find current liabilities?
They're typically shown first in the liabilities section of the balance sheet, often listed in order of maturity, though sometimes by amount or liquidation preference. They're reported at their full maturity value.
Like that Best Buy example, just listing out accounts payable, gift card liabilities, deferred revenue, accrued compensation, etc.
Exactly. Clear categories. Companies also need to disclose if any liabilities are secured by specific assets, and they need to show the current portion of any long-term debt separately.
You mentioned the current portion of long-term debt. Is debt that's maturing within a year always classified as current?
Usually, but there are exceptions. If that maturing debt is going to be retired using non-current assets, like a special fund set aside, or if it's definitely going to be refinanced on a long-term basis or converted into stock, then it can be excluded from current liabilities.
Why? Because it won't drain current assets.
Precisely. The classification follows the substance, how it's expected to be settled. Also, any debt that becomes callable by the creditor within a year,
Hmm.
maybe because the company violated a loan agreement, has to be classified as current, even if it wasn't originally due that soon.
And what about short-term debt the company plans to refinance long-term? Can they just classify it as long-term based on their intention?
Not just based on intention alone. This is a tricky area. They
Yeah.
need to demonstrate both the intent and the ability to refinance it on a long-term basis.
How do they show the ability?
Either by actually completing the long-term refinancing after the balance sheet date, but before the financial statements are officially issued, or by having a firm, non-cancelable financing agreement in place before the statements are issued.
So timing matters. If Marquardt Company pays off short-term debt with cash before issuing long-term bonds.
Then that short-term debt stays classified as current on the balance sheet date when it was paid off, because current assets were used. The subsequent long-term financing doesn't change the classification as of that earlier date.
Okay, this all feeds into analysis, right? Assessing liquidity. We talked about the current ratio. What else do analysts look at?
The acid test ratio, often called the quick ratio, is very common. It's a stricter test of immediate liquidity.
How's it calculated?
It takes only the most liquid assets, usually cash, short-term investments, and accounts receivable, net, and divides them by current liabilities.
Why exclude inventory and prepaids?
Because inventory might not sell quickly or might have to be sold at a discount, and prepaid expenses won't convert back to cash to pay liabilities. The acid test gives a sense of whether the company could pay its immediate bills without relying on selling inventory.
So Best Buy might have a current ratio over 1, but an acid test ratio well below 1.
Exactly. Their 1.10 current ratio looks okay, but the 0.44 acid test ratio suggests a heavy reliance on inventory to cover current debts, which isn't unusual for a retailer, but it's an important distinction.
This really brings up that Walmart point again. Their current ratio is often below 1. How do analysts interpret that? Isn't that a huge red flag based on these ratios?
If you just looked at the ratio, yes. But Walmart is a classic example of needing more context. They use their immense buying power and sophisticated data analysis to extend payment terms to their suppliers, sometimes for months,
So they hold on to their cash longer.
much longer. It effectively means suppliers are providing them with a significant amount of interest-free financing. This boosts Walmart's cash flow for other things, share buybacks, investments, even though it makes their current ratio look low. They've even tried to align payment terms with how long it takes the supplier to sell their inventory.
That's fascinating. A data-driven approach to working capital?
It really is. It shows how analyzing these ratios isn't just about comparing numbers. It's about understanding the underlying business strategy. But again, you have to consider the flip side, the impact on suppliers, and the difficulty it creates for investors trying to compare Walmart to companies with different models.
Definitely need to look beyond the raw numbers. Okay, finally, let's touch on the global view. Any major differences between US GAAP and IFRS regarding current liabilities?
There are quite a few similarities. The basic definitions of liabilities are similar, and both systems require classifying liabilities as current or non-current, usually presented by liquidity.
But there must be differences too.
Oh, yes. One key area is contingencies, or provisions, as IFRS calls them. When estimating a loss from a range of possible outcomes, IFRS uses the best estimate, which is often the midpoint of the range if no single outcome is most likely. GAAP, being generally more conservative here, requires using the minimum amount in the range in that situation.
Yeah, so GAAP might result in a smaller liability being recorded initially.
Potentially, yes, if there's a range and no best estimate within it. Another difference is with restructuring liabilities. IFRS allows recognizing a provision sooner, basically once the company commits to a plan. GAAP has stricter criteria, often requiring the plan to be communicated to employees before the liability can be booked.
What about terminology?
IFRS uses the term provisions for liabilities with uncertain timing or amount, like warranties or restructurings. GAAP uses contingent liabilities, and under GAAP, these are sometimes recognized, whereas under IFRS, contingent liabilities themselves are not recognized, only disclosed. Provisions are what get recognized under IFRS. It's a subtle language difference that reflects slightly different recognition approaches.
And that refinancing rule we talked about. Short-term debt expected to be refinanced long-term.
Another timing difference. IFRS requires the refinancing to be completed by the financial statement date to classify the debt as non-current. GAAP is a bit more lenient, allowing non-current classification if the refinancing happens before the financial statements are issued, which could be weeks or months later.
Interesting subtle differences there. Okay, so wrapping this all up, what's the big takeaway?
I think it boils down to this. Understanding current liabilities and contingencies isn't just an accounting exercise. It's critical for getting inside a company's financial reality.
Right, it's about seeing their short-term health, their flexibility, maybe even their strategy, like with Walmart.
Exactly. How a company manages these immediate obligations and how it accounts for those uncertain maybe liabilities reveals a ton about its operational choices, its financial discipline, and its resilience. It's often in these details, not the big headlines, where you find the real story.
So keep a close eye on that liability section and especially the notes. It tells you more than you might think.
Couldn't agree more. The ability to really analyze these is key for any informed financial decision.
Well, thank you for joining us on this deep dive into the world of current liabilities and contingencies. We certainly hope you feel better equipped to navigate this crucial part of the financial statements.
And a warm thank you from all of us on the Last Minute Lecture team.